You've heard it said that you can make money by borrowing from your life insurance to take a vacation. We'll explore that later.
You are listening to Wealth Talks, and today on Wealth Talks, you get to hear about whether you make money on a vacation when you take a policy loan to finance that, or whether it's more of a recovery or an offset of some of that cost. Taking a vacation is like an investment that you're making in your family, in your relaxation, your time for recreation. That can certainly pay big dividends. Today, you get to find out how that affects your finances as well. And we have some tips for you on when to file claim on homeowners insurance. It doesn't always make sense to file that claim for every little thing that comes up.
So you've heard it said that if you borrow from your life insurance policy to take your next vacation or to finance your car or to finance anything that you normally would finance someplace else, that you actually can make money doing that. So let's think about that for a second, because it's important the words that we use and how they reflect our understanding of things. So if I take a vacation and I put it on my MasterCard or my Visa or an American Express card, and I get home and I pay that off before there's a cycle of the billing cycle that takes place, I don't pay anybody any interest.
Maybe you actually even earned some points on the credit card.
Absolutely. If it's a point or rewards card, then I'm going to get some points back on that. So in that sense, I could earn a little bit, but actually that's more of a savings because I've planned ahead of time instead of paying cash for something. I've chosen to use a credit card that's going to give me a rebate based on the purchase that I'm making.
Certainly.
Now, if you borrow that money from your life insurance policy, then the only way for you to make the cash value that you borrowed grow is to pay yourself back the same interest rate that you would have paid anybody else that you would have borrowed money on to take that vacation. Mm-hmm. So if it was MasterCard that you borrowed it from, what is MasterCard charging? If it was American Express, what is American Express charging? And then to take the time that those credit cards or whoever loaned you the money would have given you to pay that loan back. Make the payment nice and comfortable, just like credit cards are known to do, and then take time, and over time, the interest that you are paying, not saving, you are paying yourself, will grow the cash accumulations that you borrowed from to take that vacation.
And you said the big secret word. I heard it a few times in there. The big secret word is time. T-I-M-E. It takes time for this to happen. And on something like a vacation, who's making the payments that fund the whole process? You are, right?
Absolutely.
You're making those payments out of your pocket. Your work is paying for that vacation in one form or another. So the accurate way to describe this is when you're taking a policy loan, you are still paying for the vacation. It's just over time, how much of that cost can you recover? We like to use that word recover instead of making money.
So really the only way to make money borrowing from a life insurance policy or borrowing from anybody else is to use the money that you borrowed to buy an asset. And an asset is something that generates you revenue, actually creates money for you. And that value that it creates, that new asset that you're purchasing, has to be greater than the interest that the policy loan is charging you. Mm-hmm. If that is not the case, then you will not make money borrowing from your life insurance policy to take a vacation, to buy a car, to finance business expenses or anything else like that, because this is not a magical genie that we get to rub and produce money just because we want to go out and buy ice cream cones for the whole family at $20 a scoop, or if we want to take a vacation to Tahiti and and don't have the ability to do that without borrowing from our policy.
Sure. Now, can you borrow from your policy to take a vacation, to finance business expenses, to do those things, even if there isn't the return right there, right now, if you need the money? Absolutely, you can. Again, the big secret word here is time. How much time is that money out of the policy? If it's out long term and costing you interest all that time, then there's going to be an overall cost. If it's out just for short term, then once that policy loan is paid back, the growth of the asset, your whole life insurance, will offset the time that you did have it out. So it's a balance here.
So here's the question you need to ask yourself. Putting an expense, whether it's a vacation or whether it's an automobile purchase or anything else, on credit, whether it's credit from your policy or credit on a credit card or credit from a bank or credit from an automobile dealership, or any other source of credit that you might have, you have to ask yourself, is this going to increase my monthly cash flow? Can I borrow from my policy and pay less per month back over a certain period of time that makes it more comfortable for me than if I financed it from some other source? And if that increases your monthly cash flow, that could be a very, very good decision to make, because life is all about cash flow. Cash flow is king. And so if borrowing from your policy and allowing yourself to pay back a smaller amount than other creditors would charge you and take a longer period of time to pay that back, that could be a brilliant plan for you financially. However, if you don't pay it back, then you will lose the principal that you borrowed, and you will end up paying interest and losing money, because now you've got to pay interest for that to the insurance company.
Right. And again, the big secret word here, time. And I was just looking at an example here recently. Some people came to us. They had policies before they came to us. They didn't buy the policies from us, and they had big outstanding loans, policy loans that they had taken over the years to finance, to help keep their business afloat, to run other things personally on their personal side. They were really paying more in premiums than they could afford, so they had to borrow out more over the years, and there was no cash flow that was repaying those loans steadily. And so at the rate they were going, it was going to take over 17 years, somewhere between 17 and 18 years to repay those policy loans. The cost of the interest on those policy loans is dragging out, taking away nearly all of the growth in the policies, even though those policies are performing very well.
And of course, these people were told, like many people are, that borrowing from your life insurance policy is going to make you money. Well, it only makes you money if you have a disciplined plan on how you're going to pay it back, like we talked about. Is it a good idea to borrow from your life insurance policy? Absolutely, at certain times, but you've got to judge and weigh the alternatives and make a disciplined effort to make sure that you're following the plan that you gave to pay that back. Now, you've heard me say multiple times that we have high cash value loans out against our policies, and I don't ever care if I pay them back. So let's clarify that for a second, because if your money is out in an investment earning a higher rate of return than what the interest is that you're having to pay to the insurance company, it doesn't make sense to liquidate your investment in order to pay the policy loan back, because the investment itself is paying the interest and making us money. But that's buying an asset.
Yes.
That's completely different than spending money on personal needs or a vacation or some other nominal expense that we just discretionally want to spend.
Yes, and it's also buying a legacy.
It is.
And that legacy is bigger than, just the cash value consideration. So there is a cost to the legacy, but that is buying a legacy at the same time that we're using it out. And that's one consideration as well. You have to consider the effect of both. It's cash flow, time, and the legacy that you're building. You have to think of all three of those factors.
And absolutely. But even then, if we don't pay the interest on a policy loan, it will start destroying the legacy as well.
Compounding.
It will compound against us.
Eventually it will, yes.
So the two rules that we have in our coaching and mentoring of clients is always pay your premiums, make them comfortable and affordable, and always pay the interest on any policy loan. If you've borrowed money for discretionary expenses like vacations and personal needs, then it would be a good idea to have a plan to pay that back, because that is interest that you're paying on something that's really kind of disposable in your life. However, if you've borrowed money to buy an asset that is generating more capital for you than the interest that you're having to pay for that loan, that's a wise money management decision that you've made.
Mm-hmm. Yeah, good, very good point. So an article that I'll put in the resources here for you, I wrote a number of years ago. It's about recovering money on your next vacation. Note the word recover there instead of making money. So go through, read that article if you want some more details on how this specific application works when you're taking a vacation, what it can do for you, and also what the limitations are. And that will really help along with your understanding for this process.
You know, we suffer from an Americanism, and that is if a little bit is good for you, a whole lot is better. And we just need to be really careful as you apply the freedom that you have having cash values in a life insurance policy. And just because there's cash value there doesn't mean that you have to borrow it to finance the things in your life that you're normally paying cash for. Sometimes that makes sense, sometimes it doesn't. But the rule of thumb is if you're buying an asset with it, something that is generating more money for you than what the cost of the loan is, the interest, then you are on terra firma. You're making a good plan, and it's going to work out for you.
Very good. So switching over a little bit now to homeowners insurance.
Which we don't specialize in.
That's right.
But we do know some facts about it that you maybe should be aware of as well. Because we're all about helping people keep more of the money they make. And there's no sense in you paying more for any insurance, whether it's health, auto, home, life, you name it. You don't need to pay more money for your insurance than you absolutely have to. And so looking at homeowners insurance, many people will go for a low deductible and with the idea that they're going to file claims if some minor things happen to their house because they don't want to have to pay for it. They haven't kept enough money stuck away in their life insurance or a savings account someplace to meet a higher deductible. And so they fall into a trap, don't they, John?
Yes, because if you file more than a certain number of claims during the time window, I've seen that time window anywhere from 7 to 10 years. So different insurers probably use different figures. You'll find different figures as you do research online. But if there's more than a certain number of claims filed during this time window, then your premiums will go up. And oftentimes those increased premiums will offset any of the costs that you could have saved by fixing some of those minor repairs yourself.
Well, not only will your insurance premiums go up on your homeowner's insurance, you may also get devastating news when you go to sell your house. Because the insurance company keep a record of the claims that are filed against the property, and those pop up at the time that a purchaser, when you put your house on the market, a purchaser, the lender is going to look at that insurance file, and they're going to find out how many burglaries were against your house, how many claims were filed against it, how many claims were filed that are still open because you as the homeowner decided that you were just going to fix it yourself, but you'd already told the insurance company about it. Just talking to your homeowner's insurance company will open a claim with them if you're talking about something that you're thinking about filing a claim on. That claim is opened, and it never is closed until they mark it paid. So if you decide to fix it yourself, there could be an unpaid claim out on your home, and that will raise all kinds of red flags. It also, if there's burglaries on your house, it may be a good idea not to file a claim on those. to recover small incidences or a broken window or a doorknob that's been broken, because that's going to go on and that could raise the rates for the next person that buys it, and that could kill a sale of a piece of property.
That's just one more thing in the mix there that could kill a sale very easily. So as you're thinking about this and what you could do for your homeowner's insurance, it makes sense to raise the deductible as high as you possibly can. Put the money that you would need to cover those minor expenses yourself, make sure that's sitting liquid in your life insurance cash values, where you could access quickly, go and make those repairs, and that way keep your overall home insurance premiums as low as possible. Absolutely makes sense.
John, there's something else that many people may not be aware of, and that is if you entertain in your home frequently, then it might behoove you to be thinking about a very large umbrella policy. And why is that?
Yeah, because what happens if someone is injured and it goes beyond the health bill goes beyond the limit in your homeowner's insurance policy? That would be a time when you would want umbrella insurance to come in and kick in. That's especially important if you have any sizable amount of assets, because in today's legal happy society, people sue whenever they see a pile of money to go after, if they can see any conceivable way of getting to it. It's sad, but it's an unfortunate truth.
And it's you can't really blame someone if they're faced with $500,000 of medical bills, with the medical costs rising so rapidly in this country. They're going to seek where the money is.
They're going to follow the money.
And
yes.
if you have it, and your policy, homeowner's policy, has reached its maximum payouts, then they're going to go for your personal assets as well, and that's where the umbrella policies come in and protect your personal assets above and beyond what a regular homeowner's insurance policy. So that's going to let you keep a tremendous amount of your money. And you don't even have to entertain a lot. It could be a maintenance person that comes to your yard to do some yard maintenance. It could be someone that comes into your house to fix your refrigerator that trips. We live in a very litigious society, and it just makes sense to cover all your bases.
That's right. And an umbrella insurance policy does not have to cost a lot compared to the rest of your insurance. It will vary based on how much the insurance company sees that you have in assets. It's often bundled together with your homeowner's insurance, with your auto insurance. And so you can often get a policy discount on that as well. The higher your assets, the higher the premium will be for the umbrella insurance policy. We are going to include an article in here with some of the average costs of umbrella insurance policies, so you can get a ballpark idea of what you can be looking at. So we'll include that article link in the resources for you today.
So how do you find out whether your home on your property has an unpaid or open claim still existing on it, or how many claims are against it right now?
And that's a good point. How do you find that information out?
You can go to LexisNexis and ask for your Clue report, CLUE, like the game Clue. And they will do that. It's recommended that you do that at least once a year. It's free. And that way you can find out what kind of activity is happening on your property, so that there's no unpleasant surprises if the time comes where you want to put your property up for sale. You can get those things resolved before some lender denies your future buyer the money to buy your house.
That would be very nice to do. So I will include the link for that as well for you. It's LexisNexis Personal Reports, and that link will be in the podcast resources for you today as well.
And lastly, just think twice about calling your insurance agent on your homeowner's insurance about making a claim, because the moment you make that call, the representative logs your call and a file is opened on that. And if it's not resolved by you or by the insurance company, then that's an open claim against your property. And that is something that can affect how much money you keep or how much money you get to keep from the sale of your house in the future.
Mm-hmm. So hopefully these tips are helpful for you. We'll include the links in the resources for you on this podcast. If you have any questions about this, homeowners insurance is not our area of specialty. But you can contact us. We may be able to point you in the right direction. So give us a call at 702-660-7000. We can definitely help you with the life insurance part. If you need to make sure that you have enough set aside for that deductible. You want to keep that in the life insurance policy where you get the internal rate of return, the guarantees, and also a legacy. You're doing more than one thing with that money at once. The life insurance that we help clients with is going to be wonderful for that. We can definitely help you with that.
One more thing that we need to just to inform you about, and that is if you've had claims on your homeowner's insurance and the insurance is going up or you've been denied insurance, you need to make sure that you contact the Fair Credit Reporting Act because it guarantees that you cannot be denied homeowner's insurance. And so just checking that out and making sure that if you're in a situation right now where there has been some claims filed and they're raising your rates or they've denied your care, check the Fair Credit Reporting Act, see what your rights are so that you can get that resolved.
All right. And does that vary state by state on how that's applied?
That's a federal law. And so, but each state does have further interpretations and examples that I know. Oregon and Texas, for example, are a little bit even more reaching and keeping homeowners from being denied coverage.
Okay. So that's worth looking into, not only the Fair Credit Reporting Act, but also your state provisions around property insurance, homeowners insurance in particular.
So have a great rest of your day. We'll be back right here next week with Wealth Talks, where we talk about money solutions and other things that keep more money in your pocket.
Have a wonderful week.